There is also the software concentration that needs to be looked into because of the AI risk factor. Now, private equity's decade-long affinity for software and technology-enabled services that created a concentrated risk profile is now facing disruption pressures. Industry estimates suggest that over half of the private equity transactions financed through private credit over the past 10 years carry meaningful exposure to AI-driven business model disruption. The concern extends beyond the pure play software to technology-dependent positions across healthcare, financial services, and professional service verticals. First quarter valuation marks are expected to reflect material write-downs across software-heavy portfolios. The sector that served as private equity's primary return driver is now representing its most significant vulnerability as artificial intelligence reshapes competitive dynamics and customer expectations. And then there is the leverage debate, the 2008 parallels and distinctions. The industry executives have mounted a vigorous defense against the systematic risk comparisons to 2008 financial crisis. The core segment centers on leverage differentials. Private capital vehicles typically operate at 1 to 3 times debt to equity ratios compared with 15 times or higher at the pre-crisis banks. Additionally, the longer duration, harder to redeem nature of private fund structures differs fundamentally from the overnight callable backed deposits. However, the critics note that opacity around the true portfolio valuations, the proliferation of payment-in-kind arrangements wherein borrowers add interest to principal rather than paying cash, and the interconnection of private lenders with bank financing facilities creates transmission channels that remain poorly understood. They say that the absence of crisis thus far does not preclude vulnerability under more severe conditions.